Hello folks, this is David Schlossberg from Assured Concepts Group with an educational economic update from March of 2018. In this month's video, I'll discuss some of the major headlines that influenced the markets in February. I'll also provide insight into what those developments can mean for you as an investor. Domestic markets started 2018 with their best monthly performance since 2016, only to stumble in February. Both the S&P 500 and the Dow had their first monthly losses in 10 months, breaking their longest winning streak since 1959. Overall, the S&P 500 lost 3.9%, the Dow had dropped 4.3%, and NASDAQ gave back 1.9%. These losses came as volatility picked up throughout the month. In early February, we experienced back-to-back stock sell-offs, followed by large jumps. During 1 week, the Dow lost 1,000 points and gained back 300 twice. But this volatility wasn't the result of negative economic data or geopolitical problems. Instead, a combination of emotional investing and computer-generated trading may be to blame. Essentially, investors became concerned about inflation when the labor report indicated that wage growth was picking up. In other economic news, we received a variety of positive and negative reports. The most recent data for housing showed both new and existing home sales dropped in January. Housing starts, on the other hand, hit their second highest rates since the recession. We also received the second reading of the fourth quarter gross domestic product. At 2.5%, the growth had matched expectations. Ultimately, though, worry about inflation and the resulting potential for interest rate increases contributed to much of the month's volatility. By the end of February, comments from the new Federal Reserve Chair Jerome Powell led some investors to believe that interest rates may, in fact, rise faster than anticipated. In his testimony to the House Financial Services Committee, Powell spoke of growing global strength in stimulative fiscal policy. He also said that inflation may be moving closer to the Fed's target rate. This positive view of the economy could potentially result in 4 interest rate increases in 2018 rather than the 3 that are anticipated. On February 27th, stocks dropped significantly in response to Powell's testimony. The volatility continued the next day as stocks whipped back and forth before ultimately ending down. If February's volatility feels unnerving, that may be due to the market's unusual calm in 2017. Since 1980, the average annual S&P 500 correction has been approximately 14%. Last year, however, stocks had only fluctuated by 3%. When considering last month's fluctuations, remember that positive economic perspectives were behind much of the movement. Despite the volatility, consumer confidence easily beat expectations and showed that people feel particularly good about the labor market. Jobless claims supported this perspective as new unemployment filings remain near historical lows. Moving into March, we'll pay close attention to inflation, interest rates, and investor behavior. On March 21st, the Fed may raise interest rates again and provide greater insight into their expectations for the year ahead. As developments arise, we'll keep you informed. That's it for this month's Educational Economic Update. Please remember that nothing we talk about here is a recommendation, and if you'd like to discuss your personal financial situation, please give us a call at 847-426-1077. As always, we'd be happy to talk to you. Once again, David Schlossberg with Assured Concepts Group, signing off for March of 2018. Thank you.
If you would like to discuss your portfolio or personal financial needs, please contact us at 847-426-1077. Nothing stated in this presentation should be considered an offer of a securities product nor an investment strategy. The advisors of Assured Concepts Group offer securities and investment advisory services through FSIC. FSIC is a member of FINRA and SIPC.